easiest to analyze because you still got to understand what's going on. You can have some basic knowledge over the candlestick patterns, what's going on. So what are the evening stars, morning stars, perhaps levels of support and resistance, that's just the base, trend lines. But other than that, effectively, you're not going to be just bolted around like you would in euro dollar or some other currency pair currently, simply because they are much nicer, much more predictable in terms of technical analysis. At least for the moment, effectively. We're going to be, the markets can overchange, you got to remember that. That's why we use stop losses, that's why we use take profits whenever it makes sense to use them, because you can never know what might happen in the next second. These are financial markets we're talking about. However, in general, being quite a technical asset, as they call them, it can be quite interesting to trade, of course, as long as you know how to avoid the news and you know how to avoid spikes like this. Even in this particular case, effectively, you might have quite a small triangle to trade, so until it stabilizes and you don't see anything in particular, you can even trade that. So considering those standard strategies, which you might consider over here, are practically the usual support and resistance lines, the trend lines, and perhaps some basic oscillators. Let's go through them one by one. First, the things that you have to understand how they work. First of all, support and resistances. These are the most basic fundamental concepts in all the trading. So if you don't understand those ones, either take a look at the other videos that we've done as to how you can start wrapping your head around them, or perhaps head to some resource online, check them out, see if you manage to find some guides. Stick to the free material because there's more than enough of it online. You don't really need to pay for any overpriced courses. All the material in trading you can find online, trust me. So with support and resistances, of course, once again, I wouldn't call them as basic as they are, but as soon as you start to plot them up, especially in real time, as you start to see what they represent, what you can do with them, you start getting some interesting results. So in this particular case, you can see how well the market has responded to the different levels that have held in the past. So over here, we had a moment down here, then the price stopped in this particular level. We're talking about the point of 361206. Of course, no one's considering. So let's just consider 3612. It stopped at this point, it bounced back from it a bunch of times, then it broke that level, came back to it, signed a small, as you would call it, evening star, candlestick pattern, and it went right down. Then once again it came back up, designed a small pin bar, basically spanned across two candles, and started going down. So in this particular case, it would be quite easy for you to pick it up and to write basically this whole movement. If you would expect that perhaps the Fibonacci levels hold, well, would you look at that? Basically, the level of 161 and 261 was hit just amazingly well, and it even managed to go down lower, almost to 423. So if you're not familiar with this particular indicator, we are talking about Fibonacci retracement. Very easy, very effective to use, especially when considering levels of support and resistance. Highly recommend. Practice with it. See how you can analyze the history with it first and try to apply it in your trading afterwards. So from here, we've got our price directed lower. And from here, it bounced right back up. So realistically, of course, you wouldn't know that from this point in time, it would head directly to that particular level, because here it made quite a lot of sense that it stopped at 261, but here it stopped just in the middle. So you probably wouldn't be able to catch that, and if you used any kind of trailing stop, etc., you probably would be getting out of the market around this point in time. However, if you wanted to risk it a bit more and you weren't so picky with your stops. Perhaps you could have waited till the price went back, then bounced back up. As soon as it started to go back down, perhaps you would place your stop loss over here. And as soon as you might have seen this particular candle and you've seen some indecision over here, you could say, hey, I'm getting out. And perhaps you could have effectively taken all of this movement over here. And we're talking about 36, pardon me, bars on the minute chart. So we're talking about movements that occurred in a bit more than half an hour. We're talking about 1,301 points. Now, these are not much by any standards, since we're talking about a difference of only negative 0.36%, but still, that was quite a beautiful moment. And that's not something you see too much, especially right now, on any kind of currencies. Kind of hard to find it. Now, from this point in time, what we see over here, we see our beautiful head and shoulders, designed effectively over here. Now here, realistically, you wouldn't be able to trade it as well, even if you wanted to, because after the price went down, as you can see, it bounced back up right away. It did design a new maximum over here, then it went a bit down to that new minimum that was obviously higher than the previous, and it went higher. However, what you could have expected, and what actually happened, the same level that we've considered before held as a resistance at the same point in time, once the price came back up. So once you've seen some false breakout over here, and the price actually came back up over here, once again, you could have simply entered in the market once again, either after the close of this particular candle. So let's consider this one. So you might consider opening your position basically around this point over here once the candle closed, or what would make a bit more sense to do, wait until the price would come back up, and sure it did, and try to enter the market approximately around this point in time. So you could even place a limit order, if you're not familiar with that one, go watch another video of ours, with a stop loss of around like 100, 142 points, and take a ride basically at that point in time. Now, would you look at that? Currently, we're just look at it. This is not something you're going to see all the day, basically on the currencies or nothing else. It's the same level from which it bounced back up previously. It bounced back up over here. Now, there was a bunch of false breakouts over here. Effectively, they wanted to basically get some stop losses out, but look at that. It went right down to that level once again, and it jumped straight up. Learn your supports and resistances, guys. This is really important. So once you can do those ones, of course, the next thing that you might want to consider, especially over here, are the trend lines. Also extremely powerful, extremely useful, especially with the futures, especially the speculative ones. Learn them, once again, use them. They're extremely important, extremely useful, and you get to understand what they're all about. So the first kind of strategies, first kind of tool that we might use over here, as you saw, are the regular supports and resistances. They work quite majestically. I wouldn't say that for each and every asset out there. They still hold by all means, but there are different ways in which they can hold. So depending on the kind of assets you consider, depending on the time of the year, what's going on in the market, what's going on in the world, some of them might be just too crazy to trade them. Not the futures, not the S&P. Take your supports and resistances and use them. Second of all, use your trend lines. They're quite beautiful as well. And third of all, what we want to consider over here would also be, so right now I'm looking into insert indicators, oscillators, and look at the usual stochastic oscillator. Now, over here we've got 533. That could work just as fine. And this one, oh, as you can imagine, if you had any experience whatsoever previously with the oscillators, they effectively indicate the potential points of reversal, which is also extremely useful, especially if you've been waiting for one, such, for example, what happened over here. As you could have seen after this beautiful movement down. Well, you knew the market was going to reverse. I mean, if you had any kind of trading experience, if you don't have, just get yourself a demo account, practice for a bit, get yourself some. You knew that after this kind of movement, I mean, the price is going to rebound, it's going to go up. But when is it going to go up? Is that the question? And that's what oscillators help us answer. So in this particular case, after we had all of this beautiful movement, what we could do is essentially wait for the oscillator lines to prepare to go up. And this is exactly what we saw over here. And as this stochastic started to go up, the price started to go up over here as well. So what you might have done over here, you might have waited once again for the price to come back down to this point. There was a really small and beautiful, basically, support and resistance at this point in time. Once it went up, it went back down, and then it started going up. So you might have entered around this point, place your stop loss over here, and then try to ride the wave up. And it would be quite nice wave to ride, to be honest. So we're talking about, once again, 760 points in around 10 minutes. So if you're into speculation, this is one of the best things that can happen to you. And on the other hand, now, as you might have seen, another thing that they can help you pick out is you can see when the markets are starting to get pushed. They're starting either to get pushed up or down, or they are getting held at a particular level. Because usually the market movements are cyclical. So as you can see over here, it went a bit up, then it went down. It went up and then down, up and down. This is usually how it goes. Whenever you see the price getting stuck in a particular level, either up or down, you know that probably the reversal is coming, but not before perhaps they've had a chance to get everyone they could out of the market. So I was obviously talking about hitting all the stop losses, everything that can be hit, that is done. So consider that one and take a look at what is going on over there. Now, here obviously we're talking about trading minute charts. If you're more into medium, long-term trading, of course, never go with the minutes, because otherwise you'll be too stressed out to even think how you can manage your position properly. Go with 15 minutes, go with hours, or effectively, if you really want to go something higher, 4 hours or even days. That's totally depends on the individual. But the more long-term your positions, the higher, of course, the expiration date you should pick. Because if you're planning to hold your position not for minutes, for 10 minutes, but you plan to hold it for 10 months, then you wouldn't want effectively to pick an expiration date on a contract that is going to effectively expire in 5 days. It just doesn't make any sense. However, even in that particular case, probably there are not going to be contracts available for 2 to 3 years in the future, because that's kind of hard to come by. However, always consider the kind of positions that you're going for. Always consider your personality. Once again, when we get tired repeating it, you have to adjust your trading to your personality. You don't adjust your personality to your trading. That almost never happens. It never happens in work, in business, and it never happens in trading. You get to know what you're capable of. You get to know what attracts you the most. If you're actually more into minute-to-minute trading, or if that stresses you out and the best way for you to handle your position, perhaps on 15 minutes. Or if you're into very long-term trading, perhaps hours or 4 hours. You got to consider that. You always got to keep that in mind. There's nothing you can do other than that. So, once again, support and resistances are beautiful. They must be used for everyone in every kind of asset, but particularly when you're trading S&P 500 as a future. Trend lines, also beautiful. They hold majestically. Consider them, study the history, see how they work, see what they represent, see how they serve as the dynamical levels of support and resistance. Try them out on history. Try to pick out the exact points when you might have entered in your positions, and go for that. And of course, use your oscillators. I like to use the stochastic. You can use anything you like, momentum, force index, whatever works for you. follow the waves, and whenever you see any kind of spikes in the movement, so whenever you see these kinds of movements, very sudden, very one directional, always take a look at your oscillators and see if you can pick up when there's going to be a reversal, because the more sudden the movement, the higher the likelihood that there's going to be a reversal that is just as beautiful as that kind of movement that just happened. So take a look at that. Once again, trend lines, support and resistances, trend lines. Here we have it around this point. Yeah, it was hit quite beautifully. And the oscillators. This was S&P 500 E-mini, the standard one. In the next one, we're going to be considering micro E-mini. And yeah, let's take a look at what we can do. Talk to you soon.